In this episode, we're speaking with Eliza Owen from CoreLogic, and we're going to explore what's on the cards for 2025, given that 2024 ended on a downward note. Could it be that high interest rates, cost of living pressures, and reduced borrowing capacity has finally taken its toll? Are we on the cusp of a buyer's market across the board? Or was this just a seasonal blip, typical of a spring market and competing priorities in the lead up for Christmas? What are the key factors we should be taking notice of right now as we return from holidays and gear up for the year ahead?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Our guest this week is Eliza Owen. Eliza was appointed the head of research at CoreLogic Australia in 2020. She has spent almost a decade as a housing market researcher, reporting extensively on key issues including housing affordability, credit conditions, and the impact of the COVID pandemic on housing market performance. And in addition to her role at CoreLogic, Eliza is passionate about sharing her knowledge with broader consumer audiences, which is one reason that we love to get her back to the podcast. Now, thank you so much for joining us today, Eliza. We're delighted to see you again, and Happy New Year.
Happy New Year. It's really good to be here. It's a great way to start off the year.
Eliza, thanks so much for coming on, and Happy New Year. They're probably our number one guest on the show for good reason. And it's the start of a new year. I'm sure everyone's had a good break. How are you thinking about it? And what are the things that are exciting you? What are the stories, the trends that you think that are the interesting ones to start to track this year?
So I think for the start of the year, I'm looking out for the impact of potentially rising unemployment on the property market. I've been looking over a little bit of the academic literature, and there's mixed stories, frankly, around whether unemployment has an impact on the property market or the other way around. You know, when you consider the slowdown in transaction activity, building activity. But I think given a rise in unemployment usually has the most impact for low skill and younger workers, it could actually have more of an impact on demand in the rental market, which is something we've already seen easing a little bit towards the end of 2024. It wasn't just the purchasing market that finished the year on a softer note. The normalization in net overseas migration is going to be another one. We've already started to see that through 2024. That could continue into 2025, and based on the latest Centre for Population projections, seems likely to do. And that could almost have the reverse impact on the rental market that we saw in 2023 when you had the big COVID catch-up. We could actually be coming into softening rental demand, particularly for our big international markets like Sydney and Melbourne unit markets, with growth in rents starting to get to pre-pandemic levels there.
Wow. So this is quite interesting. In fact, in the notes that I've been reading before we meet with you now, I hadn't even sort of clocked on the unemployment stuff. So that's quite fascinating. And the whole chicken and egg concept too is to what's driving what there, because of course the construction sector is such a big part of our economy. So if we let's look at the sales side of things in terms of property values. And we know that last year was a year of not uniformity. There's some capitals were struggling and others were sort of just chipping along, and the rest of, 3 were booming. So are we saying now that those 3 that were booming, Perth, Adelaide and Brisbane, are they sort of past their peak, or was that just seasonal? What are we looking at ahead for those 3 markets in particular, if we can start there?
That's a great question. So Perth, Adelaide and Brisbane have been really strong growth markets in 2024. But even at the end of 2024, it was clear that they weren't rising as quickly as what they were at the end of 2023. So Perth, for example, had the highest annual growth rate, a whopping 19% in the 2024 calendar year. But that was down from about 25% in the 12 months to April. So again, you can see even though values are still rising, they're not rising as quickly. And I think for those cities, they've still got the tailwinds of really strong interstate migration, particularly WA and Queensland. But at the end of the day, there's a difference between the fundamental need for housing versus how capable people are of purchasing that housing.
Yeah. Yeah.
So that means that affordability eventually becomes a constraint on buyers. And I think we're seeing early signs of that taking hold on those markets.
It's interesting because we did a few interviews towards the tail end of 2024 there with, an Adelaide feature and a Perth feature. I don't think we did a Brisbane feature at the end of the year though, did we? And there's all, a lot of positivity from those who are actually working in those markets around, incomes are really strong and it's still really quite affordable when you compare to the rest of the country. But what you're saying is that you're seeing evidence that that's not necessarily, got much length left in the rope. Is that what you're basically saying there?
Yeah, I mean, I think for WA, you've still got a really strong commodity cycle. Incomes are pretty good, but there is a limit to that. There is a ceiling to how much you can have, 25% year-on-year growth.
Yeah.
So I think that has to slow down eventually, even if it just leads to, I think prices will rise in 25 for those cities, but just not as strongly as what they did in 24 as a result.
Do you think, Eliza, it's coming down to investors potentially also have entered in the market. A lot of them are capping out. Borrowing capacity is really tight. So if they were going to buy and invest in property, a lot of them have probably tried over the last couple of years because they thought it was a good opportunity. Now they think, it's a bit late to the party. So, if investors aren't paying current prices, this now puts the pressure back for the locals to pay it. And that's where it's now actually what's affordable for the locals. And now you're starting to see an adjustment in those markets.
Totally. I mean, when you think about the past 5 years of change in the median dwelling value across Adelaide and Perth, it's gone from about $450,000 to over $800,000 in that space of time. That is massive whiplash for locals, first home buyers in particular. And for investors, I think they would definitely be reconsidering whether they can, whether it's a good time to get in or, as you say, whether they're a bit late to the party.
Now, we're often talking about sort of capital city markets, but there's an interesting relationship, I think, that I'm just reading one of your reports, that you've sort of drawn between regional markets in a state and its capital city counterpart, if you want to call it that. How would you explain that relationship?
Well, they tend to mirror each other. So where Perth home values had the highest year-on-year uplift of the capital cities, it was the same for regional WA. Not as strong an uplift over the year for regional WA at 16%, but it was still the highest of the greater regions. And it's the same on the other end of the spectrum, right? So Melbourne price falls were 3% in 2024, and regional Victoria was the only rest of state market to see a decline, down 2.7%. Within the regions, there is a similar trend to what you're seeing in the capital cities, where demand is tapping out at the high end of the market, and it's at the moment further afield. Cheaper markets. Townsville in Queensland is the strongest performing sub-market, not just in Queensland, but in Australia at the moment, with values up a bit over 20% in 2024. And I think for those looking to invest in the regions, they're going to have to work a bit harder. It's not the blind COVID period growth that we were seeing in all of regional Australia. It's areas that are affordable, have economic growth opportunities that are supporting population growth. So Townsville is a good example where you've got relocation of army service workers that are helping to boost the population, as well as, again, the strong commodities piece and a bit more of a diverse economic base. So maybe a bit more work for investors looking to the regions in 2025.
Eliza, we've had lots of articles late last year that's banging on month after month. Listings are up, listings are through the roof. There's this greater than 5-year averages, etc. When you see those articles, do you really believe it, or do you just think that it just makes a great story? And while the stats true, doesn't mean that there's a lot of listings on the market. How do you react when you see those articles?
I would tend to agree that stock levels are definitely higher. At the end of 2024 across Australia, they were about 5% higher than where they were at the end of 2023. And it's one of the many indicators that we're shifting to a buyer's market, because if there's more listings available, it basically means more choice, and that means more negotiating power for the buyer. It's definitely worth making the distinction between what we call new listings and total listings. So at the moment, when you read those reports about higher listings volumes, it refers to total listings, a snapshot of everything on the market at that time, no matter how long it's been advertised for sale. What tends to happen in a softer property market, though, when values are going down, is that the new listings, so the flow of fresh properties coming to the market, will slow. And that's because sellers are generally empowered to hold back from selling if they can't get the price that they want. And that's all underpinned by strong mortgage serviceability and a conservative lending environment. So, when total listings are rising, it basically means that the market's coming a little bit looser. But the flip side of that is that the listings won't look as fresh. You might see more on the market, but it might look very similar to what it did last week or the week before, with fewer fresh listings coming online.
It's a really interesting distinction. And I guess that days on market plays into that as well, doesn't it? Because that's, how long has that stuff been sitting around getting stale for? And I can't speak to other markets because I don't know them as intimately as I do Sydney. But Sydney's auction listings rate in the last, say, 2 months of the year ramped up in a way that I was shocked. I mean, I've said this on the podcast before, in 2023, I don't think we hit more than 1,000 listings in any 1 week in the auction listings, right? Whereas in 2024, we hit that a couple of times and then we sort of got to around October and we started seeing it week on week on week, and we ended up getting a couple of weeks with like 1,400, new listings every single week. And the clearance rate until, and I'm using domain, not CoreLogic clearance rates here, but the clearance rate until the first weekend of December remained in that balanced market, that sort of range of 60 to 70% in the sort of low 60s, which absolutely surprised me because that's an incredible amount of fresh stock. But I guess if prices have been softening, which we've seen, and obviously the buyer pool is a hell of a lot shallower, I guess it's that type of stock we're going to start to see swelling up in terms of the longer days on market and the stale stock. Is there any sort of green shoots or any intel you can give us at this point of time in terms of what to come in terms of listings and new listings?
Yeah, so that's actually a good point, and something I didn't mention is that the spring selling season of 24 was actually pretty strong from a new listings perspective as well, and this was right around the turn of the market, so it's probably not at that point where people are like, oh, the market's coming down, we better not sell. That the spring of 24 for Sydney in particular was probably more at the point of, the market still looks pretty strong. Obviously, if you're in Perth, Adelaide, Brisbane, you're still kind of laughing. You're still like, yes, we can sell at any time and make a really good capital gain windfall, and the markets are still fairly strong. So that was a bit of a market test, if you like. And as you say, for sellers, they failed the test because by the end of the year, CoreLogic had Sydney clearance rates trending in that mid-50s.
Yeah, they definitely dropped in December.
Yeah.
Yes. So what we're starting to see now, especially with this headline news around the national drop in values over the month of December, you might start to get a little more hesitancy from vendors. Again, it's a very mixed bag, and there are still a lot of strong markets out there. But I think you've already got Hobart and Melbourne, which were firmly buyers markets in 2024. Sydney now joining that party in 2025.
As someone who's sort of watching the market, is there any, when you always kind of, New Year's are kind of always good reference points to set new goals, but also to reflect on the year before, right? I mean, someone who's sort of tracking the market year after year, is there any sort of things that surprised you or anything? That's actually put that one in the bank. So next time I get to that part of the cycle, I'm going to think about that. Is there some things that sort of, the resilience in the market? I don't know. What are some of the things your brain thought about?
Yeah, spot on. It was the resilience in the market. I thought for sure we were going to see an earlier decline in home values off the back of the cost of living pressures, the high interest rates, the higher for longer interest rates, the affordability story. And I think what extended market performance was the change in the composition of buyers throughout the year. So the fact that it was relatively high income buyers probably that were more likely to participate in 2024. It's kind of reaffirmed by this data put out by the RBA. There was an address by Chris Kent towards the end of 2024 that showed average deposit sizes over time. That was getting bigger. That reaffirmed the idea of more well-capitalized buyers who are more resistant to high interest rates were the ones in the market. And I think I do this a lot where the market is eventually going to shift. What goes up, what must come down. But I think I'm always a bit early to call when that's going to be. And the thing we need to remember about the real estate market is it moves slowly. They're big decisions that are made. There are high transaction costs. So I think I just need to be more patient in my outlook.
I wonder if because when you look at it's good timing to be honest. CoreLogic's monthly report came out this morning. So if anyone's not getting that, you should definitely get that every month. It's
monthly chart pack.
Yeah,
the monthly chart pack.
So good.
So download that every month. It's always fascinating to quickly flick through and find some little snippets. But when you look at that, there's a graph on there that talks about the investor lending in the different states, and you can see how much that ramped up over the last 2 or 3 years. I mean, in some sense, it doesn't make sense, right? Rents have gone up, but interest rates are a hell of a lot more. Those positive cash, and you're buying in a market that's probably gone up a lot, and rates are going to be high for longer. Why do you want to buy an investment property? So, do you think that's been one of the overconfidence or the inbuilt belief in the property market to get in, even if the short-term outlook isn't great, has been one of the things that sort of saved the market from having a bit of a decline last year?
Investor participation definitely supported the market. Part of it might be because of the affordability challenge. There was a slight uptick in the portion of first home buyer loans, for example, that were for investment properties.
Yeah, absolutely.
The national growth in investment lending was about 30% in terms of the overall value increase year on year, but it was strongest in high capital growth markets. So that kind of reflects the long-term trend we've seen of investor participation aligning with capital growth, irrespective of rental market performance. And I think it might also come off the boil a bit in 2025 just because we're expecting capital growth to soften as well.
And of course, you're talking about capital growth just in a short-term sense as well. And I guess that's what investors do tend to do, don't they? They chase those short-term results and think, I don't want to miss out on this, and don't realize that compounding really needs a couple of decades at least to really work its wonderful magic. Inflation figures are out, for January when we're interviewing you, and some economists are now talking of a rate cut as early as February. Typically, how long would this take to impact the property market for us to see a change?
The interest rate?
Yeah, interest rate falls.
Yeah, great question. So like I said, the property market is a slow-moving market, but it definitely shows a reaction to movements in the cash rate and mortgage rates. The strongest correlation between interest rate movements and property market performance, interestingly, is at about a 12-month lag. And the consumer sentiment piece responds very, very quickly. So I think a rate reduction for 2025, it would have a big impact on people's confidence in the housing market and the economy more broadly. But I think it's also worth noting that there could be an anemic response. I think that a rate reduction would help to stabilize market values, maybe push them mildly higher through 2025. But we also have to consider those that already made their purchasing decisions on the assumption of rate reductions throughout 2024. So that's potentially demand that's been brought forward for a rate reduction.
That's interesting.
Yeah. And it's also the extent of the rate declines too, right?
Yeah.
Throughout the 2010s, the cash rate averaged 2.6% because we were off that GFC, structurally lower interest rates. Major bank forecasts put the cash rate, or at least at the end of last year, they had the cash rate between 3.1% at the end of 25 and 3.6%. So NAB, CBA, they were 3.1, and ANZ and Westpac were a bit higher at the end of 25. So even assuming that that's about 125 basis points passed on to a reduction in mortgage rates, it doesn't really do all that much to boost borrowing capacity relative to where values are right now.
Yeah.
And that's something to be mindful of in how that translates to the capital growth response in 2025. And we already got a little bit of a test, even though it's in a different form of boosting borrowing capacity, the stage 3 tax cuts midway through 24. Not only did it not do much for the housing market fell in value by December. So I guess those are maybe some early signals to be wary of.
Oh, it's interesting. So, I mean, I think ASX are now putting it at 3.6 to the end of next year, right? So maybe 3 or 3 cuts, let's call it. Yeah, I mean, I think it went in, I think it was August, September time, and we would have been recording podcasts there, but there was a time when there was a real confidence around rate cuts, right? And there might even be one late 2024, and there's going to be some significant rate cuts next year. Like there were, maybe 1.25, maybe 1.5 cuts, and they're coming. We absolutely straight away saw a huge spike in people wanting to get ahead of it. But I think you're right. Like if it's just going to be 2 or 3 this next year, it changes it. So yeah, rate cuts are coming, but there's not that many of them, and they're not going to come in the velocity of, bang, 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 like they've just experienced in 22 of them going up. And so I think that's going to be interesting. So maybe people aren't just going to jump on the first rate cut and go, yeah, right, the party's, over now, right now it's time to enter in, you know what I mean? And so, yeah, is that how you're thinking about it as well, or?
Yes, absolutely. I mean, don't get me wrong. I think housing market performance will still be better than otherwise. It would probably have a pretty dire impact on housing demand from a purchasing perspective if we had rate cuts further blown out. But I think the response could be very subtle, and I think that probably means a slower capital growth rate in 25 than the 4.9% achieved in the 2024 calendar year.
So you were talking earlier about the deposit sizes increasing and the RBA's data that showed that, and that to me that makes me think, the generational wealth transfer and the bank and mum and dad helping out, right? So we haven't seen this before, have we? So how does this skew? I guess how does this this value transition from established property into newly purchased properties and often wash back into established properties? How does that impact or change the way you look at the data? Because obviously it's going to change behaviour as well, and it's going to skew some of those, I guess, responses and reactions to macro environmental forces that would normally you'd see a market act one way. Now we're actually going to see different reactions. Have you been thinking about that?
100%. And like I say, I think it's one of the reasons that we saw so much resilience in the market to this rate hiking cycle. That and the fact that we were getting back into variable after that fixed rate spike through COVID. So, it's a great question. To be honest, I think it is something that's been gradually trickling into the housing market over time as we've seen more financialization of the property market and more sophisticated financial models. And what ultimately it does what it has been doing for, especially in the past decade, is create a gap between what people can afford through income and a 20% deposit alone, and then where prices actually go because they're more wealthy. So, for example, we estimate that an affordable purchase price for the median household income in Australia would be somewhere around $515,000 based on the current interest rate levels. The actual median dwelling value in Australia is about $815,000. So clearly that is already at play, whether it's through intergenerational wealth transfer or people just using the resale of property to upsize or downsize. And I think the impact is a greater removal from income and savings on asset values.
I'm on a personal mission to help more people make better property decisions, and you can find out all about what I'm working on at veronicamorgan.com.au. There you will find resources for first home buyers, details about my buyer's agent mentoring program, information about my newest project, Preferential, proactive property management in Sydney, or if you're looking to buy your dream home or investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers. And if you'd like a 30% discount plus free postage for my book Auction Ready, How to Buy Property at Auction Even Though You're Scared Shitless, and yes, I'm a potty mouth, use the code ELEPHANT at the checkout.
If you're looking to buy your first home, thinking of upgrading to a new home, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out to myself and the team at flinggroup.au.
Yeah, I mean, we've seen huge, crazy things there with intergenerational wealth over the last 2 years. Like, that's the thing that I probably never experienced, like Veronica was saying, you know, that the parents would give a bit of money to get into the 90% deposit, or would do a guarantor loan for them, or, you know, they'd make sure the debt was in the kid's name. But now they're like, well, you can't borrow anymore. You're tapped out. And they've gone and spoke to the parents' broker, and they're like, well, I know it's not possible. The only option here is to give money, right? And I don't want you to move interstate, and I don't want the grandkids to leave. And all of a sudden they're giving, and I think it's supported when you look at even your monthly chart pack. I mean, 4.1 trillion in super right now. Super's had another big year. So, you know, when they look at, you know, they're usually at that stage maybe, or they're getting close to that stage, and they're feeling wealthier because their house price has gone up, their investment properties that, you know, even though they interest rates have gone up, maybe they're a bit positive cash flows, they're probably feeling, and their home mortgage is paid down. So they're like, actually, you know what? We're feeling wealthy. Let's give it down to the kids. But I can't see that stopping. Do you think that's a little bit, though, the haves and have-nots and the inequality that's going to create over the next, say, few years when capacity is low and the people who have got access to money can borrow is really going to create a growing social issue?
Definitely. I was just thinking that as you were speaking about it, and as we know, it's already taking effect in the housing market. We're already seeing bigger declines in rates of home ownership among the young and the poor, and that's probably tied to the wealth of these prospective homeowners as well. Not everyone gets the bank of mum and dad. Not all mum and dads give money to their kids, especially if they need it for their retirement, their aged care, their health care. So that's the fundamental problem with using intergenerational wealth transfer, using the gains in property and other assets to buy property. And that's why so much of the tax conversation is around, you know, making the property market more fair in that sense. You know, like a capital gains tax on investment properties that you know, reflects the benefit of windfall gains. Even things like a broad-based land tax, which, you know, helps to redistribute wealth on owner-occupied properties as well. So, and maybe as this issue worsens over time, that's where you'll eventually get a political reaction, policy reaction. Doesn't seem like it's coming anytime soon, but that, yeah, you never know.
Is that effect of that wealth transfer more pronounced in places, say, like Sydney, than it might be compared to, say, Melbourne. Brisbane?
Yeah, I would imagine so, just off the basis of dollar value gains in Sydney being larger over time. But it's a good point too, right? Because of the shocks that we've seen across some of those more mid-sized capitals, you know, the Perth market is up 77% since the onset of the pandemic. So maybe it would happen more in those other cities. And it really highlights too, when you have such massive windfall gains over a short period of time, it really highlights the haves and the have-nots and how much of a luck of the draw it's been.
Yeah. I think that luck is not spoken enough about in regards to property. But I'm also interested too, because you said earlier about unemployment, and that's what's what's got you interested at the moment. What is happening with unemployment? Because obviously this then plays into this, doesn't it? I mean, your parents might want to give you some money, but if you don't have a job, then you're probably not buying a property. What is happening in the unemployment figures or data that's leading you to think that that's going to have an impact in 2025?
Basically, just the potential for an increase in the rate of unemployment. That's going to be one of the many factors that is changing over 2025, and it comes with the RBA trying to slow economic activity. That's why interest rates have, had to move as high as they have to slow economic demand, and that ultimately means less consumption, more people out of work, and so just interested to see how that also plays out on the market alongside things like interest rates and migration and all those other big macro factors for 25.
So you're really looking at, well, that's got to follow as opposed to you're seeing that yet.
Yeah, that's a good point. So labour market conditions are still extremely tight. And I think that tighter than what the RBA would have expected at this point. But for them to reduce the cash rate, they do need to see that slowing in inflation, economic activity, and it would have flow-on effects for the labour market as well.
How would you
Eliza,
imagine?
the election this year.
That's what I was going to ask, Chris.
There we go. I've been doing this for a long time, Veronica, so we probably should be in tuned. What do you think? I mean, they come around pretty fast, and it does feel like we're talking about another one. And I feel like we were doing this podcast in 20, what was it, 17,
19.
18, Veronica?
Well, we started in 18.
Did we start?
Oh, no.
18, yeah.
Yeah. We were doing our 20.
And
we were discussing our 2025 ep, but I think we both forgot that there was an election 3 years ago. We sort of just sleepfrogged it to 2019. Feels like they're keeping coming around.
Yeah, and housing's just such a big one. And I feel like it's a pressure cooker. And I feel like the desire to act, but also it's like the desire to stay in power or get in power. So it's like, and housing's it's hurting so many people. And, how do you think it's going to play out? And, there's some quite big policies there, particularly in the Liberal Party and Super.
Yeah, I mean, I think for the impact of the election itself, I don't think there will be much of an impact on the market. The 2019 federal election probably had some of the most bold proposals that we've seen around housing. That did see relatively low month of sales volumes in April, and prices were falling, but they were falling at the time anyway, because we were coming off that, big off-the-plan investment boom. You had the shift in macroprudential policies, which arguably had a much bigger impact on the market than the federal election.
And Easter's usually in April. Would that factor into it as well?
Yeah, I mean, it was just hard to isolate the impact of that election on the property market. And I think if that didn't really have a notable impact, then I don't know that the 25 election would, just because I think the housing policies, like you say, Chris, there are some things in there for housing around super and new housing supply. But I think from the housing supply piece, that seems like a relatively benign impact that it would have on the market. So, I think longer term, we'll probably see some political reaction. I think it's really interesting in Victoria at the moment. You guys may have seen, there's this kind of movement around reclaiming homes that are thought to be vacant.
Yeah, this is the purple pingers you're talking about.
I'm talking about purple pingers and the fact that that's reactionary, right? Whatever you think about the guy, that is what happens when you don't house people and you don't design your policy to house people. So, I mean, that kind of thing, it'll be interesting to see how that evolves if the government continues to fail people when it comes to housing.
Look, I mean, and there's lots of, interested parties arguing about what is or isn't happening in Victoria. But I think it's your data that pointed to 25,000 less investment properties at the end of the year than there were at the beginnings. Have I got that correct?
Yeah, that's right. So we've seen pretty subdued activity when it comes to investors throughout 2024. Again, that could be a response to things like the reduced land tax threshold for investment properties implemented from the start of the year. Could also be the fact that capital growth has been fairly subdued in Victoria over the past few years. It's a market that's kind of underperformed, if you like, from a capital growth perspective since 2020. So there's probably a few factors at play. I think it happens to be coinciding at a time when net overseas migration is normalizing. So funnily enough, Melbourne units are one of the few markets that have seen a decline in rents through December.
Wow.
So again, it's kind of hard to tell the impact that will have on the rental market in the short term.
Eliza, I'm going to put you on the spot here. The housing, when you look at the numbers in wealth in the country, right? Like, so looking at your report again, but 11 trillion in resi, 4 trillion in super, 3 trillion in stocks, and say 1 in commercial, right? The household wealth, right? The percentage of it in housing, like it's 55%. Like, do you know longer term whether that's been quite stable or it's gone up or down? Like I said, putting you on the spot here, like, because there's always a mental accounting, right? So when people do well in stocks, or they do well in super, or they, or they do even commercial property, or they run a business and they sell their business, then often a lot of that money flows back into residential real estate, and it might go. Have you any idea?
It tends to move with value over time, obviously, but I'd probably have to go back and check the figures over structurally how much it's changed over a longer period. The data, we derive it from RBA's statistics. So it is publicly available info. Maybe we can do link in the show notes or something, or I could just look it up.
It'd be interesting because it's like you think, as people make money in other things, whether it's buying stocks or running a business, or even crypto, right? Like often they'll make the gains and they'll bring it back into residential because they want to buy lifestyle assets. And I think a lot of people, and even like when parents are, do well, they might have some money left over from the property and they give it to the kids, or, so it's just that mental accounting so strong in property markets, I find, where often, even if other markets are doing well, that money ends up into residential real estate.
It's common amongst small business owners, that it's sort of put out as good practice that don't put all your profits back into your business. Make sure that you invest outside of your business. Property is a very safe asset, et cetera, et cetera. So, there's a lot of thinking around and about that supports that. And even think about the people that are dying to get their hands on their super balance to buy a property in their SMSF, so there is definitely a mentality in this country that, look, I don't really trust or particularly want to put too much of my wealth into assets that are not bricks and mortar. So it is a big mindset thing here. I think that there's a lot of other factors that obviously we've got to consider when it comes to housing outlook. I mean, we talked about the labour market. We've touched on construction. We've touched on affordability, but in particular with construction, because, of course, I think it's widely accepted with the federal government's target of 1.2 new dwellings over a 5-year period. And we've all forgotten when that started. I think it keeps getting brought up all the time. I keep hearing it being brought up. We're not going to make 1.2 over 5 years. Or when does the 5 years expire? But, we're not going to. The approvals are down. We recognise now that just because something's approved anyway or something's zoned doesn't mean that you're going to get enough approvals and you're not going to get construction commencements, et cetera, et cetera. So what is happening in the construction side of things?
In the construction side of things, completions and dwelling approvals are running at about 170,000 a year. So the window for the 1.2 million homes over a 5-year period started halfway through last year. And we basically need to see 240,000 delivered on an annual basis on average to meet that level.
So we're like 70 short per annum. And
yes. And so there's a lot of there's a very challenging environment to really boost that number. The closest we got over a rolling 5-year period was just under $1 million in the 5 years to mid 2019, and that was in the context of very low interest rates and the off-the-plan apartment boom that we talked about before. Units are also a much more scalable way to add to dwelling supply, just because there's more of them in each project. And so the construction industry, it's going to shift a little bit in 2025 because, yes, approvals are down, but part of that is good because it means you're going to have more capacity. So your labor, your materials are spread less thin across existing projects if you see a slowdown of new projects coming into the pipeline. And one of the features of the construction sector for resi right now is that you've got an unusually high buildup of projects that have commenced or, they're approved, but they're not yet complete. So that's sitting at roughly 250,000 dwellings at the moment. So as capacity constraints ease in the construction sector because of lower demand for new housing and also inflation, unwinding alongside that, it's probably going to help that big pipeline of works under construction to actually come to completion. And that's pretty much what you're seeing in the data at the moment, is that the shortage for residential construction is largely concentrated in the finishing trades, because that's the stage that a lot of these projects are at now. They're sort of under construction, they're waiting to be completed. Where you're starting to see capacity easing up is in the commencement stage, because dwelling approvals have been coming down. So it's a mixed picture depending on what stage of construction you're looking at. But the good news is those who have been waiting for their home to be complete might find that, that actually gets done this year.
There's been, because we haven't even talked about that, have we? I mean, that was a real issue with a lot of the smaller, the house and land package type builders that were going broke as well. We haven't even talked about it because I guess we try to discourage people from buying that sort of stuff. But I mean, what is happening there? Have a lot of those projects have they found other builders? Are there people still waiting to have their houses completed? I mean, do you have any insight into that?
Yeah, look, it's still an issue, unfortunately. The AFR had a really good article about this on the 8th of Jan with the monthly CPI data coming out. So insolvency is definitely still an issue. But interestingly, those new housing providers who are still in the house and land space are starting to offer discounts on new house and land packages to try and drum up demand.
Oh, God.
And that's actually something that contributed, the ABS wrote in their release, to a 0.6% decline in the cost of new dwellings over the month of November. So that was really interesting. And what that probably means is that those new house and land players are sort of willing to cut into their margins a little bit more to try and stimulate demand in the new housing space. So I tend to agree. I mean, I tend to prefer established when it comes to the housing market, just because there's, I guess, been such a crisis of confidence in construction, not just quality in the 2010s, but timelines in the 2020s. But, that might really help some first home buyers who are interested in that, outer suburban house and land break in.
It's just another good example about trying anything that changes in the property market is a bit like trying to turn around the Queen Mary, isn't it? It all feels at times like it's moving very, very fast, I have to say. But weirdly enough, like this whole conversation is really about very slow changes or very slow build-ups that can have big impacts, though, isn't it? It's almost like the whip in the tail.
Yeah, I mean, one thing I've definitely noticed in the construction side, the appetite to renovate was pretty much non-existent in 23 when it was out of control in 2020, 21, 22. So it kind of fell off a cliff. It went from everyone wants to renovate to no one wants to renovate, and materials went through the roof, getting labor, it costs it. But then 24 hours, every month ticked over. I feel like there was more and more clients coming back to us going, no, we're keen to make it happen now. We've finally got a builder to do a fixed price contract. We need to do it. We're never going to be able to upgrade to the next jump. So we're just going to have to make do. But we're going to spend a little bit less. So have you sort of seen any data with renovations? Because I definitely feel like that's been picking up, even though that's not getting represented in, new dwelling approvals and new houses, there is a bit of money getting spent. And ultimately that money goes into property values, right? That money's coming from somewhere. It's either coming from debt or other assets or inheritance and so, that has a huge impact on the property market as well, where it's just constant cash is getting reinvested in existing properties.
Yeah, I think that's fair. I mean, the rise in home values would support people being able to access that equity to invest back into the property. There may be some limitation with high interest rates, and capacity constraints in renovation and construction are still very real. Those prices are still much higher than what they were pre-pandemic.
Yeah, absolutely.
But yeah, I think we're starting to see a little bit of unwinding in that tight capacity, and that might promote more renovations in 2025.
It's just what goes up, what goes down. It's the same thing, isn't it? And look, the thing too is that the appetite to renovate. I mean, the reality is, I don't think there's very few people that really want to renovate. They'll renovate because they have to, and they see that that's really the only way they're going to get what they want. But if those sorts of properties are available or already done and within their budget, then I'll tell you what, most people will actually happily forego the whole, the lovely journey of renovating. Now, Eliza, it's been a really great overview of sort of where we're at and what we're looking to this year. I really appreciate that. Can you finish us off with a property dumbo? You normally have an example. Have you brought along a dumbo story for us?
I mean, I have another personal example, I guess, and maybe this will be an opportunity for a bit of residential therapy. I don't know, counseling.
Go for it.
Okay, so I live in an apartment. I love living in an apartment. It's been a relatively accessible way for me to buy into the area that I love. And I'm realizing strata has not been fun. Balcony heights are not up to code. And there's it's creating a lot of interesting tension, among the tenants. And I guess just try and get across that if you can. Because I am, yeah.
How old's the building?
I won't go into too much detail. It's a 70s building, and we're having an issue with the building codes from 2022. So
yeah. So the balustrades are too low, correct?
You nailed it.
Yeah,
you nailed it.
And all building codes get revised over and over to make buildings safer, and some like, if in a Victorian terrace, right, you would never allowed to build a house now with a staircase as steep as it is in a Victorian terrace.
Yeah.
It's practically like a ladder, right? But, in each property, there's no way that the councils are going to come around and say, right, that's it, you got to rip that out and put another staircase in. However, with balcony balustrades and window locks and things like that, particularly in apartment buildings, it's a really big safety issue. And so you can see, and it's also relatively easy to fix. But we say relatively because you've got lots of different owners, and often you've got strata managers who may not necessarily know how to corral these owners and guide them and all the rest of it. So what's the big issue? What's the problem?
So the big issue, and I think this is something that could have wider implications, is the different levels of, I guess, access to finance that owners have in being able to maintain these buildings over time.
Yeah.
Different levels of equity, ownership, wealth, especially in gentrifying areas where you have that classic thing of people who might be asset rich but cash poor. I think that's really interesting to me. And again, it's not necessarily reflective of the people of my building, but I think it's just one of these things where when you actually get into the nitty-gritty of apartment ownership, there is a lot of complexity when it comes to collective maintenance of a building.
Yeah.
And so I'm always a little property dumbo in that sense, in that I always have these little gaps that I learn along the way. And yeah,
Watch out for some interesting strata research from Eliza Owens in
I reckon.
in future times.
I reckon.
It's brewing.
It is a lot of people. I mean, it's like a lot of things in life, though. Until you actually experience it, it's really difficult to actually imagine what it's really like. And there is a big shift in apartments, in this understanding, I guess, of really how to maintain them, how to budget for that maintenance, and often these buildings, particularly those that are, say, built in the 60s and 70s, they're often been owned by a lot of retirees. It used to be the sort of buildings that people would retire and downsize into. They might be on a pension. They want to keep their running costs low, and also investors who also want to keep running costs low. So for years and years and years, a lot of these buildings, they've voted to keep the sinking fund or the capital works fund component really low, to keep their levies low, to keep the operating costs low. So, and this is the sins of the forefathers, if you want to call it that. And something that we do, we go through this with our clients when we're buying into strata as well, because we want to make sure you're not inheriting the neglect or the disinterest of previous generations. And so there's a time of reckoning. It sounds like you're in a bit of a time of reckoning.
Especially now when we think about the approach to policy, the development of cities, we effectively are asking first home buyers to consider apartments more seriously for their housing choices as the population grows and we try and house everyone. So yeah, interesting times. Thanks for letting me talk about it. And
anytime. Thank you, Eliza. Your time is always very valuable to us and to our listeners, and we really appreciate that. And we look forward to next time when we'll get you back for another update.
100%. Thanks for having me. It's been great to chat, and I wish you both a wonderful start to the year.
Thank you. Likewise.
Thanks, Eliza. We'll talk soon. Cheers.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.